Hey Mary, how are you?
Hi, everyone. Hi, Chase. Welcome.
Hey Mary, how's it going?
Pretty good. Thanks for coming today. I'm just going to give a little intro to our callers about you. So, Chase is a market strategist within the Strategic Advisory Solutions Department with Goldman Sachs Asset Management. He's responsible for analyzing macroeconomic trends, and he is the team expert on the intersection of generative artificial intelligence and investment management. Prior to joining Goldman, Chase worked in the basketball department of Creative Artists Agency, where he negotiated off-court endorsement deals for 75 NBA players. We'll have to give us the gossip about some of those players. Chase earned a Bachelor of Arts in Public Policy and a Certificate of Innovation and Entrepreneurship from Duke University. We're happy to have you, Chase. Thanks for joining us.
I am thrilled to be here. Thank you guys for having me, Carl and Mary. And something that I always like to say is that throughout my young professional career, I have always worked with AI in some capacity, and artificial intelligence is much more low maintenance than Allen Iverson. So, fun little basketball tidbit there. But, Carl, let me know what you guys ideally would like to get out of this conversation. I have a couple slides to run through. We can kind of keep it pretty high level, macro market overview, maybe do a little bit of an investment outlook, and then ultimately, as long as everyone can keep their cool, we have a couple of slides about politics as well, which will of course be a huge topic of conversation this year, especially.
Yeah, I think what would be really helpful for folks would be just, high level, where you guys see the market going, where the opportunities are. I think now as we've gotten into 2024, I mean, I was very bullish on the market in 2023. This year, I'm a little bit less optimistic, at least in the near term. So I'd love to get a pulse from Goldman as to how you maybe, if you maybe could break it down from a kind of start of the year and then more so into the second half of the year, and what your expectations are for potential recession. Kind of walk us through that. I think politics would be helpful too, as obviously that's going to have a big push on the stock market towards the latter part of the year. So yeah, I'll let you kind of take the reins, and then I'll try to interject as we go with some additional questions and thoughts.
Perfect. That sounds great to me. And you are certainly in the minority of being bullish last year, but hopefully it paid off, and that was a great call.
So far, so good.
So the way we are thinking about the economy, and basically the headline that we're using, not just for the US, but globally, is this idea of miss or misperception. And yes, a little bit of a cheeky play on words as far as, of course, misperception. But what we're really talking about is the Mona Lisa. When everyone thinks of the Mona Lisa, probably two things come to mind pretty early on. First, why are her creepy eyes following me around everywhere I go in the room? And second, what is her expression saying? Is she smiling? Is she frowning? Is she deadpan? And we don't really know. And we think that the Mona Lisa smile is a pretty good microcosm of what is happening around the global economy. There is certainly a case to be made for both bulls and bears, and at the very least, an academic case. And you basically see the economy through whatever lens that your eyes choose to perceive it. And if you're in the bearish camp, yeah, maybe you point at ISM manufacturing numbers, which have been pretty depressed for the last 12 to 16 months. And maybe you look at the still inverted yield curve, which is a pretty good indicator of a recession. But ultimately, we feel that taking a balanced look at the overall economy does sort of lend itself to this more bullish side, or at the very least, a rosier macro outlook. And we will get into some of those specific reasons a little bit later on. Very interestingly, and I was just talking about this with a couple coworkers earlier, feeling around 2024 is very similar, or at the very least, the indicators that we're hoping to see in 2024 are very similar to the indicators that we were hoping to see in 2023. Yes, as far as sentiment, we are much more positive that the Fed has successfully engineered a soft landing and ultimately will avoid a recession. But we're also still looking out for further disinflation, both in CPI and PCE. We're looking for positive, but maybe just below trend GDP growth. So we're still seeing signs of a cooling economy. And ultimately, we are still looking for softening in the labor market. So those will be kind of the three things that we will be paying attention to just from a macro US standpoint early on. And at the top right-hand section of this slide, we're basically just showing our forecast for real GDP growth. So what we're projecting is that the US will grow at a real rate of 2.3% year over year in all of 2024. And that is important because that is our potential or our trend number. And trend number basically just meaning how much would the US economy grow at full employment and full allocation of resources. So how much is the economy growing if the economy is operating efficiently? We actually think that the economy has cooled pretty sufficiently enough in light of the Fed's hiking campaign in order to bring down or soften the labor market and bring down inflation to the 2% target. Where does that leave us as far as a recession, which of course should be top of mind for all of you? Well, we only put our next 12-month recession probability at 15%, much lower than a lot of other firms on the street, and also important because 15% for us is the unconditional probability of a US recession, basically all of the time. So the quick math there is going back to World War II, the US has entered a recession every 7 or 8 years. So just a baseline 15%. We are importantly not suggesting that, oh, Fed has engineered a soft landing. We're probably not going into a recession. So let's turn everything risk on and have a similar year, or for equities to have a similar year like they did in 2023. And in fact, we actually think that a lot of optimism around a soft landing is probably already priced into equity markets. So to answer your question a little bit more directly, Carl, we actually think that the first half of this year is going to be relatively flat for US equity markets, maybe a little bit more upside. And then as we get closer to the election, and as this huge source of volatility for equities dissipates, then we could see a pretty favorable kind of year-end and Santa Claus rally like we saw in 2023. So ultimately, we think the S&P 500 ends next year at 5,100.
Okay, wow.
Yes, and any questions on there? I can take a quick pause.
So if we're thinking that markets are going to be a little bit more flattish, at least, and I say markets very broadly, call it US large cap equities.
Sure.
How are there any other areas that you guys see of opportunity, whether it be international or, I mean, obviously fixed income could be attractive if rates continue down, but any areas you guys are targeting from that perspective?
Absolutely. So from a DM equity, we'll just call it large cap sort of spectrum or grand scheme, we're pretty favorable or most favorable on Japan. Our Topix year-end price target is 2650, which is about 13% upside from current levels versus call it 7 or 8% for the S&P 500. So we are very, very favorable on that part of the world. But very importantly, we're also, and kind of a tagline we're using for 2024 is that we expect 2024 to be the year of and. So we like US and international. We like small cap and large cap. We like growth and value, cyclical and defensive, and what have you. And ultimately, given where we are in this kind of current business cycle, we're just placing much more emphasis on factors like quality versus particular style tilts. To address the second part of your question, it's probably a perfect tie into this chart on the bottom right. It's, I would say, easy to digest in that we are just showing our expected return and expected volatility for a couple of key different asset classes. But from a portfolio standpoint, the headline that we're using is back to balance. We have gone from this in 2021, especially huge TINA, or there is no alternative to US large cap equities environment, to this now TARA environment, which is there are reasonable alternatives. Not only do we expect equities fixed income, and maybe even some exposure to commodities or liquid alternatives, let's say, to drive portfolio returns. But we also like each of their role in a portfolio to hedge some of these macro risks. So yes, we are not necessarily suggesting that US large cap equities is the only way to go. And probably our highest conviction investment idea today is longer dated fixed income.
Okay, so when you talk about the longer dated fixed income,
Mhm.
maybe just kind of dive into that for some of the listeners as far as having higher interest rate risk or duration. Kind of walk through what that actually means. That way
Yeah,
they
of
can
course. So we can skip ahead
what
actually.
shifts in interest rates will and how shifts in interest rates will kind of drive returns from that perspective.
Absolutely. So I will sort of use that question as just a little bit of an opportunity to talk about our projected Fed policy path. Ultimately, we're sort of in line with market pricing. I know what Waller said yesterday was basically pump the brakes on the optimism. Markets may be getting a little bit ahead of themselves, but still, we are projecting 125 basis points of rate cuts in 2024. We think we're going to get 3 consecutive cuts in March, May, and June of 25 basis points each, another 25 basis point cut in the third quarter, and then another 25 basis point cut in the fourth quarter. Ultimately, we think that'll get us to a long-term neutral rate of around, let's say, 3.25% to 3.5%. So certainly much higher than this zero interest rate regime that we've experienced basically coming out of the global financial crisis, and especially during the height of COVID. What we are showing on this side is that, and really maybe what defined 2023 more than anything else, was this safety blanket or this warm, fuzzy feeling that 5% cash yields provided us. And they were great, and it was a really easy trade. But when you look at history, cash yields were at their 99th percentile going back, let's say, 40 or so years. So it's a pretty uncommon environment, and we have already seen cash yields decline, somewhat reasonably in this year and since December alone. But we like long dated fixed income for 3 reasons. It's painless, it's profitable, and it's protective. And I'm actually going to go back over to this slide to illustrate that idea. But what we are showing is that relative to history, the yield on the 10-year US Treasury the yield on the 10-year US Treasury note is still at its 75th percentile. So yes, maybe you would have been better off investing or extending duration a month ago, but we don't think it's too late. This idea of return asymmetry, this return asymmetry metric is almost at its 80th percentile relative to history. And what do we mean by that? Basically, if the yield on the 10-year US Treasury were to increase by 1%, which seems pretty unlikely given current levels, we would only see about a 4% or negative 4% price move. However, if the Fed ultimately does end up cutting rates according to market pricing, and yields actually go down on the 10-year by 1%, there will be almost a 12% price appreciation. And that calculation is sort of just done by using modified duration. So that return asymmetry is really exceptional in our view. And finally, we're just talking about this capacity to hedge. And this is getting back to that idea of hedging some of the broad macro risks. Let's say you are in that academic bear camp, and ultimately you do think that we're going to have a little bit more weakness just across the board. Well, if the Fed has to cut quicker than expected, fixed income, especially the 10-year US Treasury note, has a great role as far as hedging some of those equity downturns. So it's painless, it's profitable, and it's protective as far as extending duration.
Yeah, and I think what would be helpful, I guess from my perspective to add for the viewers is right now I've had a lot of questions about just holding cash, right? You can, the markets run up a bunch. Why not just put my money in cash? And what Chase has really elaborated on is those money market returns you're seeing now, or if you're locking it up in these 6 and 12-month CDs, when you go to renew, the rates at which you're going to renew they will be down significantly. One of the things is too, I also found a lot of folks that were in cash last year and they thought it was a great trade. Well, they made 5% without risk, but the S&P was up almost 20%. So, statistically, it just does not pay to be in cash over the long haul. And what Chase is really highlighting is if you are very bearish on the market, you're concerned about where things can go, you can look to fixed income. Fixed income did not work in, call it 2022 when interest rates are going up and you had, 15, 10, 15, 18% losses in the space. But by the same token, when interest rates start to come back down, you're going to have the ability to really recoup those gains. So fixed income right now, if you are in that camp where you think the markets could come down, is really, really attractive. And, I think some of these little charts here just speaking to your risk. I mean, if it goes up, interest rates go up 1%, which is very, very unlikely, you're only down 4%. But typically, a lot of these bonds are paying 5% right now. By the same token, if they drop 1% in interest rates, not only are you making the 5%, now you have the upside too on the appreciation side. So they become very, very attractive, when thinking about just overall portfolio protection and opportunity.
Yeah, I think that's exactly right, Carl. And the only other thing I would add on extending duration sort of highlights this idea of the chart on the left, where let's say you weren't necessarily in cash, but you were really trying to take advantage of those 5.5+%, let's call it 1 year or 2 year treasury yields. As soon as the Fed starts cutting, those yields are going to plummet. So you are exposing yourself as an investor to these huge this huge reinvestment risk in investing in short-dated fixed income at much, much lower yields. So the tagline we sort of use about extending duration is that the conversation you want to be having in a few months is thank goodness we extended duration when we did versus it's too bad we didn't capitalize on still those 4+% long-dated yields.
Yeah, perfect.
Cool. So let's just jump into a couple of these sources of volatility because I think it's important to highlight kind of what the bear camp or through which lens the bear camp is looking at. And what we have seen more than anything else is this really technical term I like to use, and it's that the vibes of the economy are not at its best. Consumer sentiment is really, really depressed. But what we find two factors that dictate consumer sentiment more so than anything else are prices at the pump. So that's why we saw such low consumer sentiment in 2020, and also housing affordability. And housing affordability is also really, really poor right now in its second, let's call it percentile, since 1996. So just showing that on this bottom right-hand chart here, but sentiment is very depressed. The other thing, which we'll get into in a couple of minutes, that is probably going to be the biggest driver of market volatility in 2024 is the US election. Currently, this Congress has a greater ideological divide than any Congress before this one. And that has culminated in just 31 pieces of enacted legislation by the current Congress. And just to put that into context, the average sort of annual enacted pieces of legislation sits right at around 225. So much, much, much lower than that. And the other thing that just may drive a little bit more market volatility has to do with some of these equity positioning. In 2023, it's probably safe to say that two letters drove US markets more so than anything else. And those, of course, were AI. But because so many households and so many mutual funds and so many pension plans piled into equities, we don't think that there is going to be this huge momentum trade that is really taking US equities to the next step. And we also don't think, certainly, that if there's a little bit of a drop, there's going to be that support of buying the dip, so to speak. So just goes to show, without really directionality, that we could see some more market volatility. As far as some sources of stability, this consumer reality box really lends itself to this idea of perception versus reality. And while the perception of the average consumer for the US economy is not great, in reality, it is not so bad. We're just taking a look at the misery index, which is a combination of CPI, inflation, and unemployment, and that is very, very low relative to history. And when that misery index is higher, it's worse. Inflation certainly a huge topic of conversation. We actually think that core PCE will end this year at 2.1%. So basically in line with the Fed's 2% target. And what we really need to see translate into these core PCE prints are a lowering of shelter inflation and a lowering of wage growth. And one or several of these leading indicators for shelter inflation, especially, do show that those numbers will probably start to translate into lower core PCE prints. The nice thing that we have for politics, and we'll get into this in a couple of slides as well, is that while politics are really, really interesting, they're probably statistically insignificant, at least when it comes to explaining portfolio returns. So the R squared, which explains the variation of S&P 500 returns by the party of the president, by whoever's controlling the House and what have you, is extremely low. And last but certainly not least, something that led to this huge volatility boom in 2020 is that liquidity was completely shot. But on the back of AI and on the back of that equity positioning, there was a huge increase in liquidity for equities. Any questions on any of that stuff, Carl?
How have you guys seen the kind of the movement in the money market retail funds more recently? Have you started to see more of a push towards that shift towards equities? Because I think I saw a slide recently saying that people are starting to become a little more bullish, which I feel like is typically when you want to start to become bearish, is when the general consensus is that the market's going up. How have you guys seen some of the retail money market moves more recently?
I think that's totally fair. And I think it does go back to that sort of 97th percentile of positioning. Ultimately, we do see people exiting bonds, exiting those money market funds, and piling into equities. We expect that while that trend will broadly continue, it is so high. It's another reason that we're just recommending this idea of back to balance. So if you're completely overweight equities, or if you're completely overweight, let's say US equities, there is a ton of opportunity internationally in fixed income and maybe with an asset class like alternatives.
You also have a slide here on housing. Do you guys have any, and I know this comes up all the time, do you guys have any viewpoints on not just that space in general, as far as, kind of residential and movement?
Yeah, as far as residential, we don't talk about residential a ton just as an investment opportunity. We're a little bit favorable on it in that we do think that housing prices have probably bottomed, and we expect they'll flatten out at the very least in 2024. In commercial real estate specifically, we are pretty bearish and certainly underweight in many of our portfolios there.
Any areas in okay, commercial is helpful too. That does come up. Any areas there that you see opportunity, from a segment standpoint?
It's not something that we're really addressing here.
Yeah. Okay.
So yeah, no is probably the best answer.
Okay, perfect.
Cool. And I know we only have a couple minutes left, so we can definitely focus on some of that politics stuff a little bit later on. But just to give a high level overview, at this point, we are expecting a Biden and Trump rematch. There's still a lot that can happen. The election is still 11 months away, or just about 10 months away. But at the time, Biden and Trump seems likely. What does early polling indicate? Well, that's what we're showing on this top right-hand chart over here. And it's that Biden probably has a higher ceiling, but Trump probably has a higher floor. So if we take a look at just these darker shading of bars in the bottom half of this chart, the percent of people who want Biden to run and are really excited about Biden running is only 24, as opposed to the percent of people who want Trump to run, which is 30. So Trump has a comparative advantage there. He does have the higher floor. But when you combine these two bars and you include the top half, which is showing the percent of people who, if this candidate's name appeared on the ticket, they would support this candidate, that's what gives Biden the higher ceiling. So again, even in early polling, it is way too early to make any sort of prediction, but that's sort of the takeaway that we've seen so far. And ultimately leads us to believe that this election will probably come down to voter turnout. Importantly, the other big thing we're watching is that there are 34 seats up for re-election in the Senate this year. 24 of those 34 are Democrats or independents who caucus with Democrats, and only 10 are Republicans. So now, how do we get to 270, and kind of how does the presidential election shake out? Well, if we take a look at states that are solid or lean either Democratic or Republican, what we find is that it is almost deadlock. Maybe Democrats have a slight edge, but it is pretty even. So we are going to be paying attention to these toss-up states that you see right at the bottom right section of this slide. If we use history as a guide and just take 2020, and we give Democrats the states that Biden won by more than 1% in the 2020 election, which are Michigan, Nevada, and Pennsylvania, Dems get to 266 total. And by the same logic, if we do that for Republicans, with North Carolina, they get to 235. So all of that goes to say that the three states that everyone's eyes should and probably will be on throughout 2024, Arizona, Wisconsin, and Georgia. Democrats, if history repeats itself, will only need to win one of those three states, whereas Republicans will need to win all three.
So I think this is helpful. Yeah, I kind of go into what this will do for the actual markets.
Perfect. So what we expect to see, even before we get into the next slide, is sort of what we were alluding to before, Carl, with your question, that we expect a little bit of volatility, but mostly flatness into markets. And what we've seen in past election years is that, let's call it 2 months prior to the election, as all of this uncertainty culminates and as all of this builds up, we should see a little bit of a seasonal headwind in equities. But after the second week of November, or after the first or second week of November, we should see almost all of that reverse, and that could lead to a pretty favorable seasonal tailwind and a Santa Claus rally. But
And so you're saying that just from a standpoint of, we'll get past all the kind of news and, volatility, and, once that all settles in, the market should be able to rally.
That's exactly right. And maybe even more so this year, something that I did forget to mention is that this isn't just a US election year, because about half of the global population elects a new leader this year. And certainly with some elections like Taiwan, which we just saw, Russia, Mexico, a couple other of those BRICS nations, that could lead to much heightened volatility throughout 2024. What does that mean for markets, though? Again, I said it before, while all of this stuff is really, really interesting, we would never, ever suggest that someone change his or her risk profile just based on the potential outcome of the election. It's all interesting, but it is probably statistically insignificant. So since 1930, we basically took annual S&P 500 returns under each party of president when each party was in control of the Senate and the House, and also what year of a presidential term it was. And not only are all of these returns exceptionally similar, but when you go a step further and go a little bit deeper, they are all extremely statistically insignificant. So the math term that we're using there, basically this R squared number, which is explaining the variation in S&P 500 returns, is incredibly low. So the tagline we use here, and that's the last tagline I'll give you guys today, is express your view with a vote, not with a trade.
Well, there you have it. So I think this is helpful just from a standpoint of just highlighting, don't allow the election, despite all the noise that you're going to see on the television, to really shape how you're thinking about the market. Ultimately, it's going to come down to fundamentals. As Chase mentioned, there's some great opportunities potentially in the fixed income market and overseas, at least in the first half of the year. And then we definitely see an opportunity, and I tend to agree with him, the second half of the year for kind of the US equity space. With that, if anyone wants to send in any questions to the chat box, we'll go ahead and open that up. And then, Chase, how are you guys thinking about kind of the alternative space? Whether it be if you're in the camp that the market's going to completely tank, how do you guys look at maybe like commodities, like a gold trade, or just any other alternatives in general?
Sure. So I think Commodities and liquid alternatives are really the two that we are most focused on. And I'm happy you brought up commodities because it dovetails pretty nicely with that idea of global elections. We don't know what is going to happen in the Middle East. And if any election doesn't really shake out how we thought it was going to be, if it causes a little bit more geopolitical turmoil, having commodities in a portfolio is going to hedge almost all of that risk. And we saw it already with sort of the initial invasion by Hamas of Israel, and certainly this continued conflict of supply crunches in the Red Sea, and ultimately what is going on in that region. Russia, Ukraine, definitely not over, though it may sort of be disappearing from headlines. But even Putin faces re-election, I'll use in quotes, in March of this year. So a lot of that stuff is really interesting from a commodities standpoint.
Any of those that you guys have started to lay out, potentially, I wouldn't be a black swan because you know about it, but potentially, a big issue into the future,
That's
if kind of spiral?
Sure. It's a really good question. And every time we get asked, like, what's the biggest concern for 2024? We are still saying maybe stickier inflation, maybe this idea of higher for longer for the Fed, but only because, to your point, it's so maybe unreasonable to price in this probability of a black swan event. And that is exactly why they call it a black swan. 2024 in general, just heightened volatility and again, that stickier inflation. But beyond 2024, yes, what do all of these elections mean for every country's respective next administration? And also, let's call it the 5 to 10-year problem that we're most focused on right now is US debt sustainability. Social Security and Medicare costs are rising at a pretty unsustainable rate, and interest expense for the US is doing exactly the same thing. Debt to GDP debt as a percentage of GDP, excuse me, for the US is going to be at about 150% by 2030. And I think everyone on the call can probably agree that that is a totally unsustainable path. But in the next, let's call it 3 to 5 years, the US is not going to miss any debt payments unless they choose to, and they can always issue more dollars. And there's still a huge global demand for US government debt. So ultimately, we're not really saying that'll be a concern this year.
If you were, so I think to highlight, so biggest, if you were to pinpoint one or two, just to summarize and finish up, kind of biggest concerns, for the market, through this year. And then, I guess at least more or less, if you're at home and you're starting to see things transpire in a certain segment, how should they pivot, whether it be the fixed income, how would you guys approach, some of those concerning points? And then if there's a thing from an opportunity standpoint, whether that be interest rates getting to 2%, what would be some clear points for them to really key in on?
Definitely. So again, just going back to our highest conviction idea, which is moving into some of that longer dated fixed income, we find that people are so underweight there, and it is nearly impossible to be timing this market like we saw in the past month or month and a half or so. So we are really pounding the table on getting into some of that longer dated fixed income. And importantly, we're not suggesting everyone just go out and buy 30-year government notes, but just match your portfolio's duration to that of the US ag or so. So call it intermediate, call it around 6.3%. Outside of that, the biggest underweight that we do tend to see in portfolios are both international and emerging markets. And going back to that idea of the year of and, we think that especially in Japan, as they exit their own yield curve control policies, that is a huge area of growth and opportunity for portfolios. Ultimately, going back, sort of bookending all of this just with this idea of back to balance, there is a lot of stuff to really like in markets. And there's also a lot of really good hedging opportunities for different concepts in portfolios. So we prefer a balanced portfolio.
Do you guys have any opinion? This is the last one I have on my end.
Yeah, no worries.
With regards to China, and their inclusion in portfolios right now.
Sure. Yeah. We think that obviously the COVID reopening has been much, much slower than expected. They are dealing with their own real estate problems. And ultimately, we don't think that China is going to want to do what the Fed did and totally have easing monetary policy. So we're not expecting any sort of sweeping change, a little bit more methodical, a little bit more piecemeal. China, for having said all that, China, we are kind of lukewarm on, maybe a little bit 50-50 if you want to call it, but with the rest of emerging markets, on the back of everything that is happening with China, we really like some of these global trends of deglobalization, supply chain diversification, and certainly demographic trends. So if you look at some of the narratives in emerging markets, let's call in Latin America, first to hike, first to cut, we really like what's going on with their favorable monetary policy. And there are a ton of reports that have been published lately about how India is probably going to be one of the strongest economies in the next decade. So as a result of this supply chain diversification in China, we really like India, we like Taiwan, we like South Korea, and other areas of the Asian subcontinent.
That makes a lot of sense. Does anyone have any questions before we close up here and give everyone 1 minute to send something in? And one other trade I think that's been really, everyone leaned into, right, was NVIDIA with AI. And obviously that's been an area of expertise for yourself. How are how as an investor, how would you try to get into the space? I think, the AI NVIDIA trade is a little bit crowded and probably, kind of missed the boat there. How would you be thinking about trying to tap into the market? And, do you still find it an attractive investment area?
Definitely. So broadly, and obviously I'm a little bit biased here, AI is not going to go anywhere. It is certainly going to change how we invest. It's going to change what we invest in, and it'll change how we live our lives. The best investment advice that I can give everyone is think about the companies that are going to be able to use artificial intelligence that are not necessarily some of these big tech companies. Because yes, if you are looking to hold NVIDIA in a portfolio long term, one of the best predictors of forward returns, let's call it for 10 years, happens to be current valuation. And NVIDIA's current valuation is stretched relative to history. But if you punch into Google, GS or Goldman Sachs basket of long-term beneficiaries of AI, you will get 50 names of companies that are going to be able to use AI to cut their own costs. And to give you a couple of examples, yes, Amazon is on there, big tech company, no surprises, but Zoom is on there, and Kohl's is on there, and Walmart is on there. And if I'm not mistaken, Ford is on there. So it's a lot of companies that you wouldn't necessarily think are so directly linked to AI, but once this technology becomes more mainstream and becomes more accessible, a lot of these companies are going to stand to benefit by using it.
Is it more so just from let's say Ford, I would imagine that's just from a cost cutting measure, being able to integrate that. I mean, how does
Exactly
that
right.
really flow to the workers per se? Because I think, doesn't that also pose another issue? If you increase AI, you cut jobs,
Yeah,
right?
of course. And it's probably the most common question we get whenever we bring up AI. We actually think that AI is going to complement about 2/3 of the current workforce, and is only going to replace, let's say, in the medium term, about 5 to 7% of the current workforce. And what we have found is that most of those jobs that are going to be replaced are pretty concentrated in administrative support roles and a lot of legal roles. There are two stats that I love on this topic specifically, which are since 1940, 60% of the jobs that exist today did not exist in 1940. And since that time, 85% of the creation of new jobs is directly explained by technological innovations and inventions. So as some of these jobs start to get replaced, we think that AI markets broadly are going to create a huge labor market boom quicker than a lot of these jobs are ultimately being replaced. So we're not so concerned. Certainly, people losing their jobs is a scary idea, and people being replaced by AI. But the best kind of example that I can give is this craze around robo-advising. That everyone thought that robo-advisors were going to replace FAs, but no one replaces really good eye contact, and no one replaces a great handshake. There will always be a human element involved in what a lot of these people are doing.
Oh, appreciate that. I get that question often, just, in the context of AI, and then you obviously have some of those ancillary questions with regards to what this all means for society and where things are going to go. Chase, I appreciate it. This is really helpful. I know we went and touched on a number of different topics. So thank you so much for joining us today. We definitely appreciate it, and hope everyone has a wonderful afternoon.
Thanks for having me, Carl. Thanks, Mary.
All right, take care, guys.